I'm Garrick Francis. This is the Inheritance to Income podcast, where we help families, founders, and leaders move from legacy by default to legacy by design. If you're building something for the next generation and you don't know quite what comes next, you're in the right place. I'm your legacy advocate. Let's talk about it. So it's my pleasure today to welcome Elliot Weil um, to the show and to talk some about this idea of how financing becomes a tool for legacy design. And Elliot, we've worked with Elliot now for I guess a couple of decades, off and
Absolutely.
on different things. So that's been a great pleasure. But one of the things that we're trying to do on Inheritance to Income is help people understand their options, help people understand how the market's changing and how from generation to generation things evolve. So it's great to talk to you. And first, maybe you'll tell folks a little bit about yourself and how long you've been in the financing and mortgage business industry.
Yes. Great. Well, thank you for having me, and it's been a pleasure working with you and your family. Over the years, I've been in the mortgage business for I think going on about 33
Wow.
years now, and um, I it's a passion that I have, and I really enjoy helping people use get into houses or use the equity in their house to do other things.
Right. Yeah, and you've seen a lot of change probably in those years. So,
Oh, absolutely.
what are some of the major differences you think this generation from 30 years ago is a whole generation. So from generation to what are some things that have kind of evolved?
Well, I would say the price points have definitely
Mm,
gone up tremendously over the last 5 years or so. So that has made it a little bit difficult for the first time home buyers
mm,
to get into an affordable payment.
right.
Um, and that's been one big thing. The other thing is with the housing market, over the last several years, there has been sort of low inventory.
Mm,
So it's made it tough that people have had to go into multiple offer situations, which in turn sort of pushes up the price sometimes above, the actual asking price.
right, right. So I wonder with that, lower inventory, people maybe holding on to homes a little bit more, not turning over as much. Um, are there more? Do you think now where people are inheriting homes or where parents are passing homes down? And does are there are those homes still financed? Do you have to have financing when a house changes hands from one generation to the next, or how does it work when that happens?
Yeah, so if someone inherits a home, there may be a mortgage on it, or it may be paid for,
Mm-hmm.
on free and clear. And we deal with the client depending on if they want to hold on to it, use it as a second home, use it as a primary residence, or actually use it as an investment property. We can use the current market value and then look at what's owed on the house if there's anything owed, and then we can finance that if they need cash out of it and it's paid for to do some renovations or to use it for other means. It could be to purchase a secondary residence
Mm,
or to fix up a residence. So there's a lot of various things you can do, but the nice thing is um, we can use that equity to help make it work from the
right,
financing perspective.
right. If someone does inherit a home, if it's kind of a legacy, right? They inherit the home and they go through all the steps, but there's a note on the house that's still got 10 years left, or there's some amount. What's actually the nuts and bolts process of someone, being able to then have that house as their own? Does the loan transfer? Is this a new process? What has to happen?
Yeah, so what we can do, depending on how the transaction, if it's an inheritance and it's gone to them directly, they become the owner of the home. So they now own that property at whatever the market value is. So we'll get an appraisal on that property, And then if there's a lien on it and they want to get some additional cash out of it, what we would do is just use that market value. We would get a new loan large enough to pay off the old mortgage, or if they want cash back, we can give them a larger mortgage, pay that mortgage off if there is one, and then give them excess cash to do it. And then the actual deed of the property is in their name, the new mortgage is in their name, and it transfers.
One of the things that I think I see or I hear about or people fear is that someone purchased a house 30 or 40 years ago, and it was a very good price in a neighborhood that was developing. Excuse me. And, here 30 or 40 years later, this house is now part of a booming suburb, or it's no longer just country land, and the value has skyrocketed. And so the taxes are higher, a number of things. And so younger people may find it challenging to finance that house or to own that house, or to are the qualifications for the loans the same if now they're owning that house? Because key is here is keeping that property in the family.
Right. So the qualification, if they're going to put a new mortgage on it, is still, we qualify them the same. The benefit, though, is all of that equity from the appreciation and that kind of thing. For an example, if you had a house that was purchased for under $100,000 originally, and now it's worth, $600,000, and there might be a $50,000 mortgage still on it, the new person, the person who's inherited it, gets credit for all of that equity. So we're going to look at it as it's a $600,000 home, and all they own on it is $50,000, and maybe all they need is, they want to pull $50,000 out. They just get a $100,000 mortgage, but they own a $600,000 house. So the bank is, smiling, the mortgage company, and saying, hey, they've got a ton of equity in it. So it helps their position a lot. But they still have to, you still have to qualify for it from a credit and income perspective, but it makes it a lot easier when you've got such a low loan to value, so much equity in it.
And one of the things that I know we've spoken about with some people is when somebody passes away, you're grieving and you're taking care of business. So you have to sometimes allow people a moment to step back. So what if someone inherits a property like that? What are the first things they should do in terms of understanding the ownership, in terms of understanding their responsibilities for loan payments that have to keep being paid while it's going through the process? How does that work? Or what would you advise people, the first 2 or 3 questions they should consider?
Well, I think, one of the important things is actually getting sort of what the value of the home is sort of up front, to sort of know what you're dealing with. And then you can sort of play around with, would it be something that you want to live in? Or if it's a, coastal property or a mountain property or some kind of vacation type home, is it something that you would like to continue to own and keep in the family and all of that? Or if it's a situation where they would want to possibly just sell the home, take the proceeds, and then they may do something different, another piece of real estate.
So it's really just kind of thinking about the ownership structure, the questions, and what you hope to achieve with the property, and then you can you have a little bit of time to you still have to keep the payments for the mortgage up, but you
Correct.
have a little bit of time.
Absolutely. And what depending on the individual who's purchasing it, are they willing to take on some expenses to keep it going, and how much they're willing to do.
Right. If you're hearing something in this episode that hits home with you, that resonates, and you're interested in it, please hit the like and subscribe button and share it with a family member or friend who might benefit from it as well. Helping the message to travel is what helps us build more legacy by design. And if you'd like to hear a little bit more about our sponsor, Reese Francis Studios. I hope you're enjoying this episode of Inheritance to Income. Inheritance to Income is brought to you by Reese Francis Studios. Whether you're preserving something for the future or creating something for today, photography, videography, and editing. Check out the link in the show notes below or check reesefrancisstudios.com. Okay, and so back to our conversation with Elliot. Elliot, one of the things that's fascinated me in talking about legacy is that we're in this period where this great wealth transfer or the silver tsunami, when a lot of baby boomers are trying to figure out what to do with the wealth that they've accumulated. They're the builder generation, and so they've accumulated large amounts. And so now how to transfer that, how to live it out, how to spend it is actually becoming a question. And certain times they're forced to spend part of it. And so I wonder, what are you seeing in families now if people in that situation have something to use or give, and younger people are finding it more difficult to enter the housing market?
Well, that's a great question, and I am seeing quite a bit of parents and grandparents gifting funds to help their either child or grandchild get their first home, and it can really make a tremendous amount of difference. Especially, we had talked about earlier about the price points and things have gotten higher. Obviously, interest rates have ticked up over their low point, so the cost has been a little prohibitive from a lot of first-time home buyers, and that's where the parents or grandparents have stepped in and actually gifted funds to help them get into the house and still have an affordable payment.
Wow, that's great. Does that come mostly like in the form of down payment assistance, or are they helping to co-sign? How are they fitting into that?
And we're seeing it both, but I'm seeing a lot of gifting where they may come in with a lump sum of $20,000, $50,000, sometimes even more, to reduce the overall expense. In certain cases, we are seeing actually co-signing. The parent or grandparent has a home that's paid for, they paid all their debts off, and they're still making good money from investments and retirement and pensions, and they will go on and co-sign with their with the child, with sort of the thought that sort of help them get into it, and 2 to 3 years later they can come in and refinance and take the parent off the loan.
Right. Yeah, no, that's a great way to help, and I know that's really kind of legacy building. You're both helping the younger generation understand the process, and you're aiding them financially, but you're kind of building that legacy together.
Absolutely.
It's really interesting, yeah. And another thing I think a lot of people look at a home, whether it's your first home, your second home, your forever home, as a foundation for other things. So when whether it's to buy a business or to finance a business, what are things you've seen and are seeing? Is that more prevalent now? People really using that initial wealth and equity from a home to build their entire structure?
Well, I see it a lot with someone who has got a lot of equity in their primary residence, and whether it's paid for or it's just paid down versus what's happened with the market value. And a lot of times we'll tap into that to come up with the funds to maybe fund a second home, a vacation home, or to look at an investment property to bring in some extra passive income for them. But a equity in a home can be used for all kinds of different things, and not necessarily the property that it's attached to.
Okay, yeah, no, that's great for folks to know, I think. And so, when you see somebody who is kind of successfully stepping into their ownership, especially when it's with family support, what are the tools, or what do you think the things people need to really think about to see if they're able and capable, right? Because a lot of times when folks come to you, they come They have their down payment, you check their credit, you do all the things. But in those situations where it's a bit more blended, what are the things that especially younger folks need to, and families need to think about how to prepare people to be responsible in those structures?
Well, and with first time home buyers, a lot, I try to really encourage them setting up a budget. And whenever I pre qualify somebody, I'll say, look, I'll tell you the numbers, of what you qualify, what the maximum amount that you qualify for. But most importantly, I always step back and say, what are you comfortable with? Because most people's what they qualify for may be considerably higher than what their comfort level. So I never want to push somebody to go to the max. And what I feel like is a real good process is to actually come up with a budget. And if they're currently paying rent and they're paying $1,200 a month, and they're going to maybe step up and pay $2,000 a month. Figure out, look at your budget and see how's that going to change your lifestyle. And if you've got time that you may be waiting 6 months or so, take that extra amount and put it in a savings account and just see how it feels, how your comfort level. Make sure you're not biting off more than you can handle, because nobody wants to be tied to a mortgage payment and not be able to do sort of the fun things, the travel, eating out, and those kind of things, and be maxed out of to the house.
Right. You want to live a full life, not
Right.
just own a house.
Absolutely.
That's great. Um, when people are looking at trying to create generational wealth, so maybe they're not on their first house or on their second or their third house, or they're buying a property at a mountain or a beach or a vacation home, and they're actually thinking ahead generationally, like to the next generation or to your children's children. How should they think about it if they're financing, and look, are there things they should do or set up? Is it generally the same way? Say I'm trying to make sure that I'm putting in place something I know that my grandchildren one day will potentially inherit. How are they looking at financing the same way, 20, 30, 50 years? How should they think about that?
Well, I mean, each family's different, but I think that is something to keep in mind. And if they're, want it to be debt free, just sort of look at that time frame of, whether they want to finance something maybe 15 years or 10 years, or you can take a longer period of time to keep the payment low. You can take a 30-year, but then plan to lump sum pay it off in 10 years, so it would be free and clear, for the children or grandchildren.
Right. Do you, even down to the nuts and bolts, do you put someone on the mortgage with you in those situations, or is that a question where you should sit down with an estate planner or someone to figure out what's best? How do you think about those questions?
Yeah, I think that is where a planner would come in, an estate attorney, a CPA. There are some tax rules and things, and I'm not a tax person, but there are some things. It's called stepped up in basis when, a family member ends up inheriting a home. It's better to not be on the deed a lot of times, unless it's maybe in a trust or so, because they can avoid paying the capital gains and actually get it at market value versus what the parent paid for it if you put them on now. But again, that's not my expertise, but I do see it a lot, and I'd recommend that they speak with a professional of how to best structure it.
Yeah, that's one of the things we've talked about a lot is building your team to make sure that you have people who are, a CPA, a lawyer, a financial planner, someone in the mortgage business, just to make sure you have a good team of people around you.
I 100% agree.
Yeah. And so, but there's, on the other end of the spectrum, there are people who feel completely priced out right now, because we talked about the high price points. What are there things you are seeing, recommending? Are there creative ways that younger folks, or even folks who are mid-career, who've been saving for a long time but have seen the prices maybe outpace their savings. Are there creative ways that they can think about trying to get into this market?
Well, there are, and there are a couple of, especially on a first-time home buyer. There's some specific programs. North Carolina Housing has a grant that can help people get first-time home buyers get into a home, and it's like a down payment assistance is what that is. There are also some programs through USDA, also FHA, and some conventional loans that are anywhere from 0 to 3% down. So again, they can get in for minimal out-of-pocket, funds.
Right.
Again, the price point makes it sort of tough sometimes, but there are also programs where you can buy down the interest rate to help the payment, and that can be either through your own funds or through the seller to help assist by paying some funds to buy that interest rate down permanently or a temporary buy down.
Right. Right. No, that's interesting. I think one of the things we're trying to think about is helping people understand responsibility and readiness. And so if people are even before that, and we're trying to build a legacy within our family and help counsel our children who are in their teens and 20s or in their 30s, what are some of the things where if you had an ability to go back in a time machine and sit down and tell some people in the next 5 to 6 years you need to do these things to prepare yourself for the changes in the market, some of which we know, some of which we don't. What are the pre-steps that you would say families need to think about to help build that kind of education into the family boardroom?
Yeah, well, one thing that I think is real important is for a young person who's maybe just gotten into college and that kind of thing, is trying to establish a credit score, a credit report, because you'd be sort of shocked at how many people come out of school and they've got nothing on the credit. The parents paid the college. They had an allowance, those kinds of things, and they've never had a credit card in their name. So I know with my own children, I've got two girls, and when they were in college, I put them on as an authorized user on my credit card to try to establish some credit for them. And then when they were in school, maybe their junior year, some of the credit card companies offered some benefits for college students that they could get a credit card even though they didn't have a full-time job. And I got both of mine to do that. We monitored it, talked about the paying everything on time, talked about the budget, always pay your balance off. So I think credit really starts a lot of people, who are going to buy a home, establish it, get on a budget, pay correctly. Then the other thing is the start saving at a young age, and whether it's $100 a month or $200, start putting that down, get into a good habit of doing that, so that when you do get to the point of getting ready to buy a home, you've got your credit in check, you've saved some money, you understand the budget and paying bills, and I just think that starts every young person off in the right direction.
Yeah, that's great. So one thing, you mentioned your two daughters, and I know you've been in this business a long time. So one thing I go off the beaten path a little bit and ask guests is to think about their own legacy, to think about the things you've done, to think about your family. And so if somebody were to say to you or to your children's children, to ask them what your legacy has been or had been 15 years from now, when you think about your own legacy, what is it that you hope your legacy is? And what's the design that you've created for your legacy?
Well, I think, going back to going back to my daughters, I just think for them to always be on a good financial footing, to understand that you should spend less than you make. You should pay your bills. You should do all that to keep your credit score up high. You should save. If you've got not mortgage related, but I just feel like buying a property as early as you can, and if you have, if you're working with a company that offers a 401k, or even if you don't, invest in an IRA. And I've just always felt like, I've tried to instill in both my girls to, own real estate and invest in that retirement, and put away savings, and you'll have a great life.
Yeah. It sounds like the strategy behind the asset matters almost as much as the asset.
Absolutely.
Yeah.
And you just have to be diligent and do it. And if you do it for, 50, 60 years, everything works out.
Yeah, that's really interesting. So and again, what you've been describing, it kind of seems is really putting in the right structures in place. And so when people come to you, say it's not their primary residence, you talk about real estate, owning real estate, and how have things changed, and how today are people looking at getting into the real estate business or the real estate game? We hear a lot of things about, I know I talk to my children about house hacking, about finding a property they can live in and rent out or do different things. So what are some of the ways today that if people are trying to get into the real estate game to build a legacy and generational impact and generational wealth, that they should be thinking about it?
Well, one of the things that I see over and over again is people who understand, it's not always guaranteed, but typically real estate over time is going to grow in value. You're going to have little, blips where value may drop down for a year or so, but if you keep it long enough and are not in a situation that you have to sell, real estate is a fantastic investment. And a younger person starting out, if they can put a minimum down, anywhere from 0 to 5% down, live in the house a couple of years, and during that period of time, they're saving money for another down payment. They turn that property into an investment property, rent it out at hopefully a positive cash flow, and again, someone else is paying their mortgage, paying it down, and the value of the house continues to go up. And they do that, and they do it multiple times, and they retain the house, and I see that quite a bit.
Right. Yeah. These are it sounds like really legacy design pillars of how to put in place things that'll last for a long time, as opposed to thinking of them all as separate assets. Buy a house, sell a house. Buy a house, sell a house. It's how do I build for the future?
Right. And that is true, and that's where people can end up with 2, 3, 4 pieces of real estate, and it all started from a primary residence, and they kept upgrading the primary residence and turned the property into an investment.
Right.
And they got a nice portfolio.
And that's even a situation where maybe somebody comes in and, as you mentioned earlier, I think, they could qualify for a whole lot more. And they could qualify for a bigger house or more expensive place. But maybe their first step is to buy something a little smaller with the plan to flip into something else in a few years and own that as a rental.
Absolutely. And I remember one specific client that I've had for years. He really got into a quadruplex, a 4-unit property, and the financing allows for, he would buy one of them as his, move in one of the units as a primary, and he ended up with 3 investment properties. And he did that multiple times and ended up with multiple, either duplexes, triplexes, or quadruplex. And that was I felt like a real creative way to have all your properties under sort of one roof, and you could maintain them, see what's going on, and you actually live there. But instead of going out and buying a real expensive house, they did this as an investment, plus a primary residence for themselves.
And that sounds like a fantastic I would call it a legacy design strategy, where I know I've talked to people, they said, well, I should buy a first home and use that. Another person said, no, I should rent a home and buy a rental property. And then there's this other hybrid option, which is I'm going to buy a small multifamily, live in it as my primary for you'd have to ask a tax attorney, a couple of years.
Right.
And then I'm going to do it again, and I'm going to own these properties over time. So, yeah, I mean, they're fascinating. I think strategy and how you design it is really key.
Absolutely. And from the financing standpoint, if something's a primary residence versus an investment property, it is a considerable difference in the down payment. So when somebody can move into something as a primary, their minimum down is 5%. Where if it's an investment property, it could be 20 to 25% down. So by doing that strategy, you're able to spread that money around into multiple properties.
One other kind of nuts and bolts question I think that comes to mind is, over the years we've had, and I've heard a lot of people use home equity or HELOC, so there are a lot of acronyms. And so how is that being used today?
Well, and we're seeing it a lot currently, because people who already have homes that did a mortgage, in the last 10 years or so, may have rates that are in the upper twos to upper threes, and they do not want to get rid of that mortgage. So instead of paying that off and getting a brand new mortgage, we keep that one in place because they've got a unbelievable rate, and we just come in with a second mortgage, whether it's a home equity line of credit or just a fixed rate second mortgage. And that's a great way to pull money out, but still keep that preferred financing in place.
Right, right. And as I think we mentioned, that's another way, if people have an inherited property, they have a lot of equity in a home, they can use that equity to do other things, whether it's for that home or something else. Again, we're trying to encourage inheritance to income.
Absolutely, and they can use it to remodel another property that they have. They can do it to fund a business. There's all kinds of different reasons for pulling cash out.
Right. No, that's great. That's great. So as we kind of draw, I guess, start to draw to a close here, if a family is really thinking generationally, and we encourage them to, not just about buying a home or building something that lasts, what should they really be? What do people overlook? What are some of the things that you think people, or common mistakes, or I just call them unaccustomed conversations people aren't having to think about as they come into your sphere of influence?
Well, I just think all families should really talk about, sort of be open about what you want, and to get the children and grandchildren involved, and sort of talk about what your wishes are, and if they're in a position to help out their children or grandchildren, I think it's a great idea. And I think it's to have a parent or a grandparent to sort of mentor you while you're young, to sort of show you how to do what you need to do to be on that right path, is fantastic. And I think that there is a lot of wealth out there that people don't know exactly what to do with. But I think talking to the children while you can, and sort of explaining sort of what your thoughts are and philosophies, and get them sort of involved at an early age, I think it makes it really good, that when the time comes that they inherit it, how to handle that money and what to do with it, and what my parents would do, or what my grandparents would do, and you've had that talk.
Yeah, no, that's wonderful. We talk a lot about making sure that your values are part of the inheritance. Talking about those things, talking about where things came from and why the family values certain things, and that goes into that legacy box just as much as the coins and the money and the deeds and everything else that people need to have.
Yep, agreed.
Yeah, no, that's great. Well, again, Elliot, I really want to thank you. And before we go, though, I do want to give you just a second to tell people, if they're interested in your knowledge, which we have taken advantage of for 2 decades, how could they find you?
Yeah, well, I appreciate that. They can find me. It's Elliot Weil. I'm with Equity Resources here in Raleigh, and my telephone number is 919-616-6598, and would love to talk to you.
That's great. The other thing I think I'm well aware of and thankful for is that when you do have a team of people and you do have people you can work with over the decades, they understand your family and the values that we talk about. And I know I've appreciated over the years how you have worked with our family in a number of different ways, and I think that's been a really you understand where we want to go, and that's been a really strong component of what you've offered, and so we're grateful for that.
Well, thank you.
Yeah. And so, building a legacy and designing a legacy takes work. It takes a team. It takes knowledge. It takes the nuts and bolts of knowing where you want to go and how you want to get there. But it also takes the actual know how. And so, take time to have the unaccustomed conversations with your family, with your children. Bring them in so they know what's important to you for the generations, and so that we can continue to build generation by generation. So again, if you've heard something on this episode of Inheritance to Income that moves you, that you're questioning, that you're trying to understand, hit that like and subscribe button so you can get more information. Engage with us, reach out to us, DM us, let us know what you want to hear more about. And so, again, I want to thank you for the time that you've granted us. I don't take it lightly. I'm Garrick Francis. This is Inheritance to Income. God bless.